China holds over $765 billion of US bonds, making it the third largest foreign holder of US bonds just after the UK and the Japan. So these bonds are actually loans that the US government takes when it spends more than it earns from taxes and exports. Now with tensions rising between China and the USA, many wonder what happens if China dumps all of its US bonds. Would it crash the US economy, destroy the dollar, and bring America to its knees? Let's see. So let's understand this. When China is selling US bonds, it's basically selling US government debts. So what happens? Simple economics. When there's more supply of anything, its price goes down. So when there's more supply of US bonds, when China sells the US bonds, its price will go down. So the bond prices fall. And with the bond prices falling, the interest rate, the yield for the US bonds goes up. Why? One of the reasons is because when a major investor like China starts selling US bonds, then other investors may get panicked. It will signal risk or at least uncertainty. So to attract new buyers in this shaky environment, the US government will have to pay more interest to attract new investors. And we know that the US government has to meet its expenses and hence has to issue new US bonds anyways. Now, if the yields rise, the same borrowing becomes more expensive for the US government. For example, if the US borrowed $5 trillion at a 3% interest rate, the interest cost would be 3% of $5 trillion. That's a $150 billion a year. But if interest rates rise to 4%, the same $5 trillion now costs $200 billion a year in interest for the US government. That's an extra $50 billion every single year just in interest to the US government. That makes America's $37 trillion of debt even costlier to manage. And here's where it can go global. So the dollar isn't just America's currency, it's the world's reserve currency. It's used in international trade, oil contracts, and sits in the foreign exchange reserves of almost every major country. So let's take India and Russia for example. As of the recent data, their central banks hold hundreds of billions of US dollars. India holds $702 billion of US reserves, while Russia holds $620 billion of US reserves. So if the dollar weakens, the value of these reserves will also drop. These countries suddenly will have less purchasing power on the global stage. So this creates a ripple effect across trade, investments, and currency markets worldwide. So in short, yes, it seems that if China sells the US bonds, the US economy takes a hit and also the world economy will take a hit. It seems, but. Now comes the twist. Rather than asking what happens if China sells US bonds, the better and more apt question is, will China sell its US bonds? Probably no, and here's why. So let's look at the Chinese economy. Why does China hold so many of US bonds at the first place? What do you think? The reason is like this. China's economy is an export-driven economy. That means its economic growth depends on the exports of its manufacturers and the businesses in China. For example, in 2024, exports contributed to almost 20% of the Chinese GDP. And guess who's one of the Chinese biggest customers? Yes, you guessed it right, the United States of America. And here's where it gets interesting. When a Chinese manufacturer sells products to an American businessman, it gets paid in the US dollar, right? But the Chinese employees of this Chinese manufacturer needs to be paid in the Chinese yuan and not US dollar, right? So what does the Chinese manufacturer do with the US dollars? Let me illustrate this by taking examples of two people, Mr. Z in China and Mr. Stephen in United States of America. So Mr. Stephen buys electronics from Mr. Z's company and pays in dollars. But Mr. Z wants to pay his workers in the Chinese yuan. So he goes to a Chinese bank, exchanges dollars for yuan. That means the bank ends up with lots of US dollars and lesser yuan. Too many dollars chasing too little yuan. That pushes the yuan's value up. If nothing is done, over time, the Chinese yuan will keep on appreciating against US dollar. This is in fact a mechanism called self-correction that happens between two currencies. When two countries trade, then their currencies self-correct. For example, in the case of China and America, if there is no intervention, over time what happens is the value of yuan will increase and the value of dollar will decrease. But in that case, what happens is China has a problem. When the Chinese yuan increases, then the value of its exports or cost of its exports also rises, and that's bad for China. So in our example, let's say an iPhone case made in China used to cost $10 for Mr. Stephen. Now because of a stronger yuan, it costs $13. Maybe Mr. Stephen decides to buy from Vietnam instead and not China. Boom, China loses a business here. So in order to curtail this problem, the Chinese government intervenes here. The People's Bank of China steps in. It buys those extra US dollars from the banks. Remember Mr. Z exchanged US dollars for the Chinese yuan? So the People's Bank of China will purchase those US dollars from the banks, from the Chinese banks. And now it reinvests these US dollars to buy US bonds. Why US bonds? Because US bonds are safe assets, at least for the time being. This way, the People's Bank of China intervenes at regular intervals, keeping the US dollar stronger as compared to the Chinese yuan. And hence, it helps Chinese exporters to stay competitive at the world stage. So ironically, China is protecting its own economy by buying US bonds. And that's why dumping those US bonds would be shooting itself on the foot for China. But let's say, just for argument's sake, China decides to hurt the US by selling its US bonds. Would it crash the US economy? Honestly, no, not likely. And here's why. This is right that China holds about $765 billion of US bonds, and that sounds huge, right? It sounds huge only until you realize that it's just 2% of all the US government debt. Let me say that again, just 2% of that over $37 trillion of US debt. Then who does the US owns its debt to? So more than 70% of the US debt is held by Americans themselves, the Federal Reserve, pension funds, insurance companies, mutual funds, and even regular people buying the treasury bonds. Foreign investors together hold only around 24%. So if China exits, yes, markets would shake for a while. In short, there may be turbulence but no collapse. So the ongoing fear of China's holding of US bonds and China dumping its US bonds is uncalled for. Both these economies are intertwined. China needs America to sell its exports and US needs China to fund its expenses. What do you think? Let me know in the comments, and please like and subscribe if you found this video valuable. Thank you.